Hello, everyone. Thank you for attending. This is SeeWing Yee from the Yee Real Estate Network. And my special guest once again is Mr. Richard.advani from Supreme Lending. His company specializing doing mostly investment loans in all 50 states. He and his staff have done an outstanding job helping hundreds of investors every year to get financing for investment loans. And he also does owner-occupied loans as well, primary home buyers doing the owner-occupied loans. He also does refinancing of primary homes and refinancing of investment homes as well. So he does it all, but his specialty is that understanding the real estate investors, wherever market they are buying in any of the 50 states, he have the ability and the resources and to help you to get the financing investment loans to buy investment properties. So welcome, Richard.advani. I know you're busy running your business. So it's just before you go over the specific of the investment loan programs as we speak, can you provide a high level thoughts about why we continue to have a very low interest rate and then for especially for the remaining of this year, 2021, and even beyond 2022, what are the potential downfall of what may cause a rising of the interest rate? Because if the interest rate rises to like 4.5% to 5% or even slightly higher, then we can have a very, very challenging real estate market. It could cause the market to I wouldn't say crash, but it really have a drastic slowdown with the market if the interest rate go beyond, in my opinion, around 5% or something like that. So yeah, go do your 5-minute update, high level, then we talk about investment loan programs.
Absolutely, yeah. So I mean, to kind of carry off on your last point, I'd say, right now primary home rates are sub 3%, right? They're in the high twos. So for rates to go up to 5%, which I agree, that'd probably have pretty good impact on the market. But you're talking about a huge increase that would need to happen. Now, one thing to keep in mind is, firstly, mortgage rates are predicted to stay pretty low throughout the end of the year. It's tough to say what's going to happen next year just with COVID and the next strain coming out, as well as obviously inflation. Right now, the Fed, they're meeting today actually, and of course they're saying that inflation is transitory. But with all the money that was printed in the last couple of years, I can't imagine the inflation being here for the short term. But I mean, another thing that we all need to keep in mind is even if rates move up 0.5%, I mean, right now you're getting investor rates with 25% down in the mid 3% range. And that's where primary homes were up until about a year and a half ago. And that was the lowest they had ever been. So, in my opinion, even if rates move up 1/4, 3/8, 0.5% by the end of the year, which I don't think is likely. But even if they do, you're talking about low 4%, 30-year fix on an investment property, which, once again, the lowest you can get really, even at the bottom was the mid 4s, and we're our worst case, I think, through the end of the year is getting to the low 4s. So I'd say rates are going to stay attractive. But, one thing I think all of us are seeing as investors is, we always talk about, and people always say how real estate is a good hedge against inflation. And so is obviously a 30-year fixed. And we're definitely seeing it because, all the properties all of us bought, in the last 3 to 5 years, today the rent has gone up 30% on most of them, maybe 35%. And, I attribute a lot of that to the dollar, obviously not having as much purchase power. Just because of inflation itself. So the beautiful thing is, rates are still low right now. So you get into a 30-year fixed at a low interest rate, rents are going to keep going up. Inflation is going to happen, right? The cost of bread is going to be 30% higher in 4 or 5 years, or maybe even less these days. And what's not going to change, though, is your mortgage payment. And, you know, rates are incredibly, incredibly low. So, you know, definitely don't sit on the sidelines, as we always say. But yeah, and then one more thing to cover is, you know, interest rates have hit a little bit of a low point, I would say, in the last 6 months. Part of that is, you know, about a year and a half ago, maybe 2 years ago, Fannie Mae themselves and Freddie Mac themselves added a half point adverse market fee onto their pricing. So it was across the industry. Obviously, everyone went up half a point overnight. And a lot of that was because of, you know, the future loan losses that they saw coming, you know, through COVID and forbearance and everything else. And a week ago, they lifted that, which, you know, not only is amazing because obviously rates moved down with that a half a point went away, but also to me, that was a pretty good sign of the real estate market. I mean, if they added this as a precaution a year and a half ago when everything was still good, you know, and now they've removed it where things are in a lot of people's mind too good, right? And everything's so high. And we, you know, some people are talking about, oh, is there going to be a bust or is there not? Well, you know, Fannie Mae, Freddie Mac, that has billions and billions and billions in mortgages on these high-priced homes that supposedly we're buying, they just removed that. So I think that's a good sign, once again, into the overall state of the housing market. And I was reading an article actually earlier today, I think it was in the Wall Street Journal, basically saying, you know, what we've talked about, SeeWing, is, you know, what's different this time around versus last time? You know, and everyone's like, it smells like 2007, 2008. Well, a lot's changed. I mean, before there was a fake demand created by people getting loans that couldn't qualify, you know, and some people getting 3, 4, 5 loans. You had good credit and a heartbeat, you can go buy a home. Well, guess what? When it's that easy to go buy a home and people aren't qualified, it creates an artificial demand. And with Dodd-Frank and everything else that occurred, the demand that is being seen in the market now isn't a false demand, right? The demand's because there are a lot of qualified people trying to enter the housing market. The millennial generations are starting to buy homes and there's not enough inventory. It's simple economics. So, sorry, it kicked me off here. There we are. So it's simple economics at the end of the day. It's a supply and demand situation that exists right now is, in my opinion, it's based on purely availability versus obviously the buying force. And that buying force being as aggressive as it is based on strong fundamentals. So, you know, I don't know. I can't imagine house prices going down anytime soon. You know, they may level off, but we thought that was going to happen a year and a half ago. And, you know, a lot of markets have gone up 20% in the last 12 months. And I'm not talking about just California. I'm talking about Midwest, everywhere, you know. So, yeah, it's exciting times to be a real estate investor.
Yeah, that's what I'm seeing, Richard. I totally agree with you. So all those naysayers, all those, I watching YouTube channels quite a bit, you know, just to be curious what the real estate people out there are saying. But you know, people saying, you know, crash this and that. It's not likely to happen. But you know, what I've seen is, you know, inventory is slowly, you know, picking up. You know, people start to sell some of their homes. And yet still the supply is very, very low compared to demand, and the new constructions are still are behind schedule with the skyrocketing lumber costs and it's just all the delays associated with that. So yeah, it's all about the market is all about lack of supply, and it's going to be around for a few more years. I mean, we're still having some markets that we work with in Texas and Florida. We have like 3 weeks supply of homes, and where a 6 month supply is a balanced market. So it'll take a while before we can get to a balanced market. Who knows when? 2 years, maybe? I don't know. So at the end of the day, the next few years, like you just said, low interest rate, still lack of supply. Demand still going to continue to be strong. So yeah, you know, like I said, I mean, there's a slight slowdown in a real estate market, maybe because of the summer right now, but it'll pick up, I think, when the fall comes around. So just Yeah, so things are still doing very well. So as an investor, you know, I mean, we focus on selling investment homes with cash flow. I mean, you know, you and I a year ago, you know, my cutoff for our investors buying, single family homes is around 200,000 because the rent is only like 1,600. So the cash flow, because of the rental value ratio, is 0.7 or 1%. But now we're promoting single family residential investment homes in different markets in Florida and Texas, in North Carolina, approaching 300 to 330,000. It's a surprise for me to say promote these homes because the rent, like you said, the rent has increased 20 to 30% in the last couple of years. And now we're getting renters that have the ability to pay $2,000 to $2,200 to rent a $320,000 home. And with the, like you said, with 3.5% interest rate for investor, when some investor put 20% down payment, we can still cash flow at, quite nicely at like 5% cap rate on a $340,000 single family home, 4-bedroom, 2-bath, 2,000 square foot, because the rent has risen so much, and there's so many renters out there. People paying $2,200, Richard. They are making like 80 grand per year, and those people, high quality renters, they can't buy because of a lack of homes to buy in their market that we're promoting, in those markets that we're promoting, and perhaps they have no lack of down payment, or they're not ready to. They don't have sufficient credit, so they are relegated to renting for a few more years to come. So that's why we're seeing, our markets in central Texas, in the suburbs of Austin, in San Antonio, in Florida, Southwest Florida, Central Florida, and North Carolina, Raleigh, Charlotte. I mean, yeah, we're promoting the higher price homes, but it's all about the numbers. It'll cash flow because all those reasons. I mean, which is pretty amazing. So there's still a lot of opportunity for investors out there to get cash flow, even if you buy single family homes for 320, 330, 340K. Even Las Vegas, for example, for the longest time, for the past 8 years, we couldn't promote there because of the rent to value ratio so low. Now the rent has catch up in Las Vegas, 2,300 monthly rent to rent a $330,000 homes. All right, so let's get back to we only have 5 minutes. I know you're very busy. So investment loan programs. So let's get back to that. So Fannie Mae lending guideline, which what we're focusing on. So with less than with single family home investments, so 20% down. How many loans can you get for investor with 20% down?
Unlimited, actually. So we can loan up to 10 Fannie Mae loans, of course. We do have non-traditional 30-year fixed options that have no limit on the number of finance properties that you can have as well, which is incredible.
Okay, help me understand. The Fannie Mae lending guideline is still up to 10 mortgages, a single family home, duplex, and fourplex, up to 4 units. Is that still the case, right?
Correct.
So, all right, let's say somebody want to buy a hypothetical 10 single family investment homes. Can they do all 10 with 20% down payment?
Yeah, absolutely.
Okay, so assuming they have a FICO score, like preferably higher the better, like 720 or higher FICO score, they fully qualify with 20% down single family home. So your investor is getting a rate of mid threes, around 3.5. Is that my understanding?
Mid threes is with 25% down. 20% down is generally the high threes.
Or high threes, like 3.8, something like that.
3.9 to 4.25 in that range.
Oh, I see. All right, now beyond the single family homes, we talk about duplex to 4 units. Again, within the guideline, the Fannie Mae lending guideline. What are the minimal down payment to buy duplex, triplex, and fourplex? And what are the interest rate on that?
25% down typically for multi-units. In terms of rates, I think it's a little better to get into those specific scenarios on loan amounts, obviously with clients directly. But Same thing in the low 4% range typically for multi-units.
Oh, so duplex, triplex, fourplex is the low fours, 4.2, 4.3, those range, right?
Correct.
Still not bad. And my final question is something, what if somebody, okay, ideally, when somebody have a 10 loan goal with the Fannie Mae, they buy a combination of single family home, 3 or 4 single family home, 3 or 4 duplexes, because when somebody using an investment loan to buy a duplex or a triplex or fourplex, it's still considered one loan per borrower. So there's a economy of scale. I get all that. What if somebody, my final question to you is, why somebody max out with the 10 loan on a Fannie Mae lending guidelines? What are the options after that? If they still want to buy more properties, if they still want to get investment loans, what are investors' options?
Yeah, we have a non-traditional program that allows you to go beyond 10, still have 30-year fixed in the mid 4% range typically. And those are actually no documentation. They're based on the property itself and the cash flow itself. So those we're doing a lot of those loans.
Those are what are the down payments for those loans?
The same as the Fannie Mae. So 20% down for single family, 25% down for multi-unit.
So there are no doc loans. So you don't have to. Someone does not need a tax return or even a W-2 wage stubs or whatever. Is that what you're saying?
Correct.
Are they your loan programs? They are non-Fannie Mae lending guidelines, right? They are like non-conforming private
Correct.
loans, right?
Correct.
Something that your company does specifically, or what how are you able to do this kind of financing?
We work with numerous investors, so I'm sure there's other companies that have similar programs as we do, but we work with all kinds of investors to ensure that there's loan options for our clients that move over 10.
Yeah, that's not bad. I mean, for no doc loan, 25% down payment, and the rate is a 30-year amortized loan.
Correct.
For those people that have more than 10 mortgages. Wow,
yeah,
that's very interesting. I mean, that's not so bad. So what about, we talk about commercial. I know I don't want to spend too much time on it. Just 2 more minutes. What about somebody want to buy a 5 or 6 unit? I mean, what are their loan options?
Generally, they would need to obtain commercial financing. It's not something I can offer, but they would need to get an actual commercial loan.
Right, I see.
Anything 5 units and up.
Okay, very good. I think that's it. I think we have discussed everything we need to discuss. So before I let you go, you have any kind of final thoughts about investors out there, contemplating buying, creating a real estate portfolio, and so what is your high level thoughts?
Well, I guess I'll just say one thing is I'll share my biggest regret in investing in real estate with everyone, and I think a lot of people share the same sentiment. And it's simply not buying more. Mm-hmm. But know what you're buying and make informed decisions, but go out there and do it. There's and if you don't necessarily have the means, let's say, hey, buying a $300 or $150,000 property may be realistic for you, but prices are higher now, and maybe you need to go in that $350,000, $400,000 range to buy a multi-unit or different type of property that will generate more cash flow. Don't be afraid to take on partners too. You've got a family member, a good friend, go in on it with them, split the down payment. Instead of buying a $150,000 home, well, if you get 3 of you together, you could buy a $500,000 home with the same amount of down payment. You spread the risk, and if it works well, obviously you go and buy more properties with those people. So, don't be afraid to be creative to make these deals happen.
That's right, Richard. That's what you do, right? All these years, you've been helping people using creative financing, or there's a way, there's a will. So that's what you do. You help people. That's why investors need to talk to you so you could go over their investment goals, just review their financial profile, do a pre-qualification, pre-approval for them before they start picking a property. So you are the first step for many investors, especially newbie investors out there. understanding financing, understand the leverage, understand the benefit of using loans to leverage wealth, real estate wise, is the key to financial freedom. So thank you so much once again, Richard.advani. You always provide some great perspective in education to help people. Thank you so much, and have a nice day.
Thank you.
All right. Okay. Bye bye.